My name is Scott Van Den Berg, and I'm one of the vice presidents here at Century Management. I'm joined here this afternoon with my father and company president, Arnold Van Den Berg. And this afternoon, we're going to take the opportunity to answer the frequently asked questions that many of you have had over the last month or two. So, without further ado, why don't we get started with our first question, and that is, many of you are worried that we could go back and test the lows that we saw in the market in March of 2009. Arnold, what are your thoughts about this?
Well, Scott, I think that anything is possible in this kind of an environment, although I believe that the risk of the market going back to the March low, which was around 670, is very, very low. And I've worked out 4 or 5 reasons why I believe that's so. First of all, when this crisis happened, I have never seen in my 40 years the companies react as quickly to cutting costs, reducing payroll, cutting dividends, cutting capital spending, and just getting everything honed down. And because of this rapid reaction to it, and it was probably due to the fear that was going on at that time, these companies have been able to really get themselves in good shape. Matter of fact, the balance sheets of America's corporation has got the most cash relative to assets in the past 22 years. The profit margins are improving dramatically, and it's hard to believe, but the profit margins are almost as high as they were in 2007, which was a record year. Just to give you an example, in 2007, the corporations in America earned about $1.4 trillion. It got as low as $1.1 trillion in 2008 and 2009, and now this year we're projected to go to 1.417, which is not quite as high, but almost there. It's almost 95% there. So here we had this tremendous decline in economic activities, a decline in all of the profits, and 2.5 to 3 years later, they're almost back up to where they were before. Matter of fact, when you measure GDP, the gross domestic product, it is actually higher now than it was in 2007. So when you take the fundamentals, the earnings that are back up, when you consider that the sales, which is the GDP, is back up, you can see that the market doesn't have any reason to go any lower. That would be one of the reasons. The second reason is, which I want to talk about, is the valuation of the market. And now I'm going to introduce a price-to-book chart, a chart of the S&P. Now, we know that companies have earnings, they have cash flow, and they have book value, and book value is just the net assets of the company. So if we take the S&P as an index, and we measure how much book value it is, and we look at the price-to-book, we get an idea of what is cheap or expensive. Now, usually you use earnings or yield or cash flow or free cash flow, but I chose price to sales and price to book because those things are two constants. In other words, they don't move around as much as the cash flow or even as much as the earnings. So if you take the very low periods in this market history, and we all know that stock prices fluctuate around interest rates. So I took a chart and I said, okay, all of the interest rates below 9.25 and less. In other words...
And what interest rates are you referring to?
I'm using the BAA rate, which is the investment grade bond. And usually the market trades in relationship to that. For example, when the BAA got to a real extreme at the March of 2009, it got to 1.5 times book. There's only one time in the last 21 years when that ratio got that low, and it was 1.72 times book, and that was with a 10.75 yield instead of 9. So you can see that out of the past 20 years, the ratio below 2 times book has only happened twice. Both times the interest rates were 10.75 and 9%, and we're at a 6% interest rate now, so the book value ratio should be much higher. Matter of fact, if we take the extreme, 2 times book is about as low as this market should trade with the earnings and the interest rates in this present environment. and yet it got to 1.52. And that shows you how extreme this market was because of that reaction. So if we look at 2 times book, the book value in the S&P is about 528. 2 times book is over 1050. And it probably would not have gone any lower than that if it wasn't for the layman thing and the mark-to-market accounting, which I'm going to discuss next. So basically, when you look at this extreme, and when you take a look at the last 20 years, it only spent 1.5 years out of the 20 in that low valuation.
Below 2 times book?
Yeah, but out of 20 years, it only spent about 1.5 years there. So that's where my statement comes from. I don't believe the market will go down that low, but if it did, it wouldn't stay very long, as it hasn't over the last 20 years.
Now, our Century Management portfolio, our CM Value 1 composite, which represents our average account, it's currently has a price to book value of 2.12 times book.
Right.
So based on what you just said, then that would suggest that there is a lot of value in the companies we're holding.
Relative to values over the past 20 years, that's about as low as a price to book we've had, except for those 2 periods. So our portfolio is actually a lot cheaper than the S&P. Now, I'd like to introduce another chart, which is the price to sale. It basically tells the same story, but some people can relate to the price to book easier. Other people use the price to sales. And the reason we like price to sales is because the sales don't fluctuate as widely as the earnings do. So price to book, the assets are more stable, the sales are more stable. The thing that really moves around is the price to earnings. So if we look at the price to sales, the real cheap point was in 1990, just like the price to book, it was at 0.64. It was 0.74 in 2009. And you can see by the chart now, it's a little bit over 1.10, but that's pretty low relative to any other period except that period in 1990 when the interest rates were 10.7.
And this is on the price to sales ratio for the S&P 500.
That's correct.